Hi, I'm Dan Mikulskis, Head of DB Pensions at Redington, and the purpose of this short video is to illustrate the power of interactive tools in helping trustees set investment strategy and to understand some of the trade-offs behind investment decision-making. Okay, so here I'm going to run a quick ALM analysis for a typical pension scheme using Redington's interactive tools. We've preloaded some data into the system to represent a typical pension scheme. The first thing that we would do is to set up the objectives. And our first decision here is what basis to view the liabilities on. Here I'm going to choose a self-sufficiency basis. The second choice is to select a target full funding date. Here I'm going to choose 2030. Next, we're going to decide how we want to measure risk. I'm going to choose a funding ratio at risk measure, or FRA. Finally, we need to enter the size of the assets and liabilities. Now, the tool has projected our assets and liabilities and calculated the return we need to meet our objective. That's gilts plus 2.5% per annum, and we can see that here. The scheme's current investment strategy is displayed here. In our view, the scheme isn't currently set up to meet the objectives. The expected return is likely to fall short of the objective at around gilts plus 2% per annum, so the scheme is not on target. What's more, we set ourselves a risk budget of 10%, and we can see that the current strategy has a risk level of about 12%. We can see that here. So we're outside the risk budget. Okay, so let's try and drill down a little bit further into the risks and see what key levers we have and how we might be able to solve this problem. So, looking at the current strategy through a risk lens, what we can see are two clear contributors to the overall risk. First, we can see equity risk, that's here, and secondly, we can see interest rate risk, that's here. That's the largest contributor to the overall risk. This suggests that one thing we can look at straight away is extending liability hedging. Now, the current strategy invests some assets in bonds, but doesn't do any additional hedging beyond that. So, if we turn on interest rate and inflation hedging up to 65%, you can quickly see that that reduces our risk quite materially. That's probably the primary lever we have to get that funding ratio risk down. And we can see that with that additional liability hedging, the risk has gone down from about 12% to about 8%. Now that's within our risk budget, but on the return front, we're still not on track to meet our goals. When we look at the current investment strategy, the allocation is illustrated here. Like most pension schemes, it has a significant allocation to developed market equities. That sits within what we've labelled liquid markets, and that component of the strategy we've labelled here in blue. The scheme has a small allocation to corporate bonds, that's shown in orange as part of liquid credit. This small red slice here, that represents an allocation to property, that's within the illiquid market section of the portfolio. Finally, the green allocation is to LDI strategies. In this case, that's an allocation to index-linked gilts. What I've done here is to set up two alternative higher returning strategies. You can see that this strategy here makes use of a range of diversified beta strategies within liquid markets. It also makes use of some higher returning strategies within credit, namely multi-class credit and absolute return credit. This new purple section here, that's an allocation to high returning assets within illiquid credit. For example, direct lending and secured leases. We think that the strategy shown here, labelled as Strategy 1, would deliver a return of around gilts plus 3% per annum, which would enable the pension scheme to reach full funding around 2 years earlier. Alternatively, Strategy 2 shows a slightly lower risk, lower return version, allocating proportionally more to credit strategies. This hits the target in 2030. So, to wrap up, this panel gives an overview of our starting point and a number of alternative strategies. We started from a place that was below the scheme's required return, represented by the dotted line, and too risky, represented by being over to the right-hand side of this diagram. By using liability hedging and more diversifying asset strategies, we've managed to meet the scheme's required return and reduce risk, putting the scheme on a more stable path to full funding.